What up, guys? We back again with another YouTube video. In this particular video, I actually want to touch on something that I have been very skilled at doing in the real estate business for years, and I thought I'd share exactly what it is, especially considering at the time of this video in 2026, the economy is not necessarily the best for buyers when it comes to commercial, when it comes to residential. Even when it comes to, just people just living in general, a lot of people right now have horrible credit. A lot of people, have repos on their credit report. They have derogatory things on their credit report. And while having good credit is a good ordeal for a lot of people who live in America, um, there are ways that you can purchase real estate of any form, whether it's a wholesale deal, whether it's a traditional real estate deal, whether it's a commercial property, without having good credit. And a lot of times without even having capital as well too. So now, of course, this particular video is not financial advice, nor, am I a financial advisor, nor am I an accountant of any sort. But these are things that I have studied, and I've done several deals, and I've helped facilitate several deals when it came to the wholesale world, when it came to traditional real estate world, that I'm actually giving to you guys today for free. And it is called creative financing. Now, creative financing is a niche in real estate that a lot of people tend to start using. It's been around for years and decades and whatnot, but a lot of people started, bringing more notoriety to it around after the 2008 crash. Now, for any of you guys, who are old enough to remember, in 2008, horrible time to live in America for most people. A lot of people lost investments in real estate. A lot of people lost their whole life savings in the stock market. A lot of people had to rebuild straight from scratch. Well, a lot of people who had bad credit after, filing for bankruptcy, losing everything and having to get it back, a lot of these people bought more property and more investment vehicles, even businesses, using creative financing. Now, what is creative financing? Creative financing is the non-traditional way used to purchase or finance a property, pretty much bypassing a regular traditional mortgage. Essentially, what it does is it involves a flexible, often customized type structure, like what you would say seller finance, subject to loans, or particularly lease options. And there's multiple different things and ways that you can kind of structure creative financing. It really kind of just depends on your situation and how you're negotiating. And of course, how your real estate agent is negotiating. Now, I'm going to name for you probably the more 4 notable ways that people can do creative financing. And these are all things that I've actually done myself. And I've actually worked with several different people. I actually just recently did a creative finance deal more recently. It was actually the last deal that I closed, where I helped somebody who actually ran out of money get a hard money loan in 5 days. And we actually closed on the property actually, I think it was like a week ago or so. But number 1 is the traditional seller financing. A traditional seller financing deal is where the seller accesses the bank, which they're going to hold the note, and they're actually going to be receiving continuous payments from a buyer. Of course, any of these deals that you do creative finance, highly recommend that you always use a title company. A title company will essentially review the contracts, structure any deal how it's supposed to be structured, and it's actually recorded through the county or state that you live in. Seller financing traditional is pretty straightforward. I mean, essentially, you and the seller kind of negotiating, what your down payment is going to be, if it's a down payment, what the interest is going to be. More notably, I think we did a deal, owner finance deal for a car wash, in which I think the interest was like 2 or 4%. They had to put down like $45,000 down, and then they're pretty much financing the next 5 years or so. Balloon payment in 5 years. Purchase price 130, and that's pretty much simple. It's not, and seller financing is pretty much is kind of negotiable and based on what the two parties want and what they agree to. That's pretty much it. The next form of creative financing is one that I actually learned from a guy named Pace Morby. He's one of the more experienced people who actually came up with the term subject to. And of course, you can go check out his YouTube channel. That's one of the people who taught me the subject to term and how to go about it. And essentially, what a subject to deal is when a buyer pretty much takes over an existing mortgage, and they're actually taking over the existing mortgage payments without actually assuming the loan, which would be leaving the loan in a seller's name. Now, of course, I highly recommend, before you try to go about using the subject to strategy, that you definitely talk with an attorney. Also, have a title company facilitate these deals. And then here's why. A lot of people like to do subject to deals and, try to organize, somebody taking over your payment for you, or even somebody even assuming the mortgage. And some people's mortgages are not assumable. And a lot of people, where I've seen most people go wrong in the real estate world and in most deals, especially when it comes to creative financing or just deals in general, even wholesaling, is not properly communicating to all parties that are involved. Every time I've seen where communication has been an issue, the deal has 9 times out of 10 probably fell apart. Or we've ran into issues where lawsuits have been filed and this, that, and the third, right? Now, of course, with subject to, I highly recommend that you do your own research on subject to, but it's pretty much simple. Essentially, typically you'll have people, because, most people don't buy their properties cash. A lot of people still have a note on their property. And a lot of people, especially in a time like this, is a lot of people have issues making their mortgage payments. Well, evidently, your mortgage still has to be paid in order for you to still own the property. Well, a lot of people have figured out, found out about subject to, and pretty much, investors are coming in, hey, I give you a certain amount of money down and I'll take over your mortgage payment. And a lot of people have got cleared off the debt for the most part, and they were actually able to sell their property subject to, and the real estate agent still got paid the same, and everybody left happy. The third option is what I would call lease. It's called a lease option. And it was also, what some people like to say is a lease to purchase. And essentially what it is where a tenant is actually leasing the property with an option or an obligation to buy it at a later date. Now, this is something that comes around, like it gets popular every once in a while. A lot of people who I've seen actually try to utilize the whole lease to own option are people who probably don't have enough money for a down payment. They probably have just enough money for like a simple deposit. They kind of just want to rent, and they don't really don't have the money to make repairs. But, some people do craft their deals to where they can still lease a property, have the owner still fix up the property, and they pay rent. And evidently, if the owner does want to sell the property, the tenant has first dibs on purchasing the property. The fourth one would be hard money loans. And this is, like I said earlier in the video, this is something that I actually recently just worked with. And essentially what a hard money loan is a short-term, high interest-based loan that's from private investors that's often used for fix and flips. Essentially, why a lot of people like hard money loans is because, let's say, you're working on a deal, whether it's a wholesale deal, you can't get it assigned, or let's say you're working on a deal where you pretty much just ran out of money. Like the last deal that I just closed on, like it was like 1 or 2 weeks ago, my guy, when I got him under contract, he literally ran out of money. He didn't have the money to finish the deal. So we were able to help them get, a hard money loan, and we were able to finish the deal. Now, the con of getting hard money loans, guys, is that a hard money loan can ruin your life if you don't know what you're doing. Hard money loans, when I tell you they are high interest, they are high interest. And some of these hard money loans not only come with a high interest rate, but they also come with a short term payoff. For example, the hard money loan that I was able to help my client was able to secure, he has to pay it off in 4 months, meaning that they need to go ahead and flip that property as fast as possible and hope that when we list the property that we can sell it super fast so we can get that loan paid off so more interest doesn't get tagged along. So those are certain things that you do have to worry about with hard money loan, but the reason why a lot of people like them and use them is because you can have bad credit, and typically, even with you having bad credit, you can kind of still get approved, and you can relatively get approved a lot faster than you would have to wait like 30 or 40 days to get approved for a traditional mortgage, even like an investment loan. So that's why a lot of people like it. I think this is number 5. Number 5 is what I would call crowdfunding or private money, right? So, and this is pretty much just raising funds from private individuals or online platforms to basically fund real estate projects. People do it all the time. I personally would never do it myself. And the reason why is because I personally don't really like using other people's money to buy real estate. I've seen it go worst when people use other people's money than I've seen it actually go good. And I personally rather just take the risk on with my own money rather than trying to go borrow it from somebody else. Then you run into issues, people, trying to sue you, et cetera, et cetera. But, see each your own. It's still an option. A lot of people do it. Crowdfunding, private money. And then also, one of the reasons I'm kind of against, crowdfunding and private money when it comes to real estate financing or creative financing of sorts is because a lot of times when you do crowdfunding or private money or partnerships on investment properties, people tend to get scammed or their business partner ends up screwing them. I've yet to kind of see a deal where private money was involved outside of hard money loans where somebody didn't get scammed or they felt like they got scammed, if you know what I mean. So it's very interesting. Those are pretty much the only things. Now, here's the thing. So the thing with creative financing is that, number one, the terms are super flexible. Typically, they require a lower down payment, and they enable deals with poor credit and allows for faster acquisitions. Now, the risk and the cons is that, typically when you're dealing with creative financing, it has the potential to have higher interest rates and also complex legal issues. So this is why I tell people all the time, make sure you use a title company when you're trying to do creative financing of any sort, because this will protect you so much, or even use a real estate attorney to facilitate these deals, because this will save you so much trouble. And then, of course, the more notable risk that, a lot of people should be aware of is the risk of default. When you're doing these creative deals, a person can stop paying at any time. And, of course, if you use a title company, it's actually a pretty easy process. It's just kind of long to kind of get the property back into your name. But, if you did everything like I told you guys to do in the video, you wouldn't have those issues. Make sure you guys like, subscribe, and share. Let me know how you like this video. Got more on the way.